right, well, welcome everyone to the OneAZ webinar on life insurance and long-term care, protecting those who matter most. You know, life insurance has the potential to offer protection at critical times for those who matter the most to us. And life insurance needs actually are different at different times in our lives. During our working years, for example, life insurance may be able to help your loved ones avoid the drastic change in lifestyle in the event of your passing. And then in retirement, life insurance can be positioned to offer additional tax and estate benefits. Regardless of your life stage, we'll be covering an overview of how and what life insurance is about. We're also going to touch on 8 ways to pay for long-term care. Now, we've had this question come up quite a bit, and we figured we'd do a little segment on just how do people pay for long-term care. Now, we are not, I say, going to do a deep dive in looking at different types of long-term care policies or strategies. We're going to hold that for a webinar in the spring. However, today we're going to talk about 8 ways people typically pay for it. First, here is our informational page. It contains our required legal disclosures for your convenience. I ask you always to be checking our OneAZwealth.com website for upcoming webinar events. For better audio, the webinar will be in a listen-only mode. We will be fielding questions at the end of the webinar, so please, if you haven't already, I would like you to email any questions you have to oneazwealth@oneazcu.com. We've compiled a number of questions that have come in already, and if you have any questions even after today's presentation, please email those to us and we'll respond to you individually and directly. Lastly, for more information about OneAZ Wealth Management and all about our advisors and the services we make available, I urge you again to visit our website, oneazwealth.com, or if you have a mobile device, you can scan the QR code right there on the screen, and that'll take you right to our website. You can also connect with us on social media, on Facebook, LinkedIn, and YouTube for more exciting resources and information about our organization and what we bring to the table for you. First of all, I'd like to also introduce myself. My name's Tom Mitchell. I am the Senior Vice President of OneAZ Wealth Management here at the OneAZ Credit Union. Our full-time staff of professional advisors are assisting clients and members of the OneAZ Credit Union all over the great state of Arizona. And we're very excited to bring you these educational topics directly to you. And we're actually planning on a few more still here in 2024. And we're lining up our calendar for 25. So be checking our website. Tonight, we actually have Tori Jewett. Tori Jewett is our guest speaker. Tori has over 20 years of experience. He's one of our wealth advisors. He's been helping individuals and families pursue their long-term financial goals for, as I say, about 20 years. Tori begins all of his engagements and his meetings with his clients by listening and taking time to get to know his clients, get to know their families and their personal needs and desires. He specializes in creating a custom-tailored financial plan and strategy built so it can address their individual financial goals at every stage of their lives. Now, Tori began his career as a financial advisor while working with Nationwide Insurance back in 2007. And then he later joined OneAZ Credit Union in 2010. So basically 14 years, which is great. He completed his training to earn the designation CRPC. What does that mean? CRPC is a Chartered Retirement Planning Counselor. He earned that back in 2011. Tori is originally from northern Vermont, where he graduated from the London State College with a bachelor's degree in administration. He moved to Arizona and has been a resident in Cottonwood, Arizona since 2010. He and his son Brody love to be outdoors, kayaking, or even practicing their golf swings. Tori is also fully licensed on insurance here in Arizona and has his registrations with LPL Financial, both his Series 7 and 66. So he's fully licensed. So Tori, are you there?
I'm here, Tom.
Excellent. Great, Tori. Well, let me just mention who the agenda and what the agenda is about, and then we're going to turn it over to you.
Sounds good.
Yep. So today's agenda, here's what we have going on. We're going to talk about insurance, life insurance. We're going to talk about what it is, why, and how much should you have. And then we're going to talk about the types of life insurance to kind of give some education there. And then lastly, we'll finish with long-term care. We'll talk about some strategies in order to pay for it. So that'll be interesting. We'll get into that in details. Well, but without further ado, let me turn it over to you, Tori. Why don't you talk about life insurance?
Thanks for the introduction, Tom. I appreciate it. You always do a wonderful job. Okay, folks, I'm going to do a brief overview of life insurance. Some of the terms might be a little foreign. I'll do what I can to backtrack and maybe explain them a little bit more clear. But like Tom said earlier in the presentation, if you have any detailed questions or inquiries, don't be afraid to email the Wealth Management Department, and one of us will get back to you. So let's begin with life insurance. It's easy to view life insurance as an obligation rather than an opportunity, an obligation that can be put off. But life insurance does offer many benefits. We all know life insurance can provide funds to pay our last expenses, including estate taxes and other costs. Life insurance potentially may be able to replace your income and help maintain your family's standard of living after you die. In addition, life insurance may be able to protect your family's home by paying off that mortgage and any other debts. Proceeds of life insurance policies can be used to pay others to do some of the tasks you routinely used to do, such as caring for your aging parents or any children. Life insurance has the potential to ensure that your children or grandchildren will have the funds to go on to college. Life insurance can provide a supplemental retirement income for your spouse or your partner. An insurance policy may be able to provide funds to help settle your estate to equalize otherwise unequal gifts to children. And I touched on this earlier. If that sounds a little odd, it's because with a life insurance policy, it's one of only 3 investments out there that actually have beneficiary designation. And if there's 2 beneficiaries, we don't have to have it 50% each one. You could do 25 and 75, 60, 40, however you wanted to split it. Life insurance can also be used to pay expenses incurred to keep a small business in the family. Several factors will affect the cost and ability of life insurance, including your age, health, and the type and amount of insurance purchased. Life insurance policies have expenses, including the mortality and other charges. If a policy is surrendered prematurely, the policyholder also may pay surrender charge and have income tax implications. You should consider determining whether you are insurable before implementing a strategy involving life insurance. Any guarantees associated with a policy are dependent on the ability of the issuing insurance company to continue making the claim payments. Okay, to understand life insurance, you need to understand the answers to these 3 questions. First, how does it work? How does life insurance function? Step by step. Second, how much do you need? How much insurance coverage will it take to meet your obligations? And third, what are the life insurance choices? First, how does life insurance work? Life insurance is a contract between you and the insurance company. Under this arrangement, the insurance company agrees to pay your beneficiaries as a specific amount of money when you die. In return, you agree to pay a premium, either in regular payments or as a lump sum. Any guarantees associated with a policy are dependent on the ability of the issuing insurance company to continue making the claim payments. The insurance companies have developed a number of variations on these arrangements, but it forms the basis of all insurance policies. How much life insurance do you need? There's a general estimate available based on multiples of your income. If you're looking for a more accurate estimate, consider completing a DNA test. A DNA test is a detailed needs analysis. That takes into account a wide range of financial commitments to help better underestimate your insurance needs. The first step is to add up needs and obligations. Next, look at your family's long-term needs. How much will it cost to maintain your family's standard of living? How much is spent on necessities like housing, food, clothing, etc.? Consider factoring in expenses such as travel and entertainment. Answering the question, what is it going to cost a year to maintain your family's lifestyle? Will children or grandchildren need help with college costs, and so on? Next, take a hard look at your family's liquid assets. Liquid assets are assets that can be redeemed quickly and for a predictable price. Generally, houses and cars are not considered liquid assets since they may require time to sell, and because selling them may adjust your family's standard of living. Needs and obligations minus liquid assets can help you arrive at a better idea about the amount of life insurance coverage you may need. Keep in mind that this is just a quick exercise. While it's good to start understanding your insurance needs, a more detailed review may be necessary to better assess your situation.
Yeah. Let me make a comment here, Tori. You're right on. I tell you, that is so important. And people's needs change over time. So what you did, or what maybe a calculation you might have done 10 or 15, 20 years ago, really might be quite different today for a variety of reasons. You may have more expenses, more debts. You may have more obligations you need to recognize. You might even have less. So the most important thing is, do you have the right amount of insurance? Don't have a penny more, but certainly don't have a penny less than you really need. And that's truly called out. Something I'll mention, I'd like to call this out, is why do people buy the insurance? They buy it really for two basic reasons. And those two reasons are, one, how much, how much do they owe? That's the old terminology. What do you owe in debts and your liabilities? But then how much do you love somebody? In effect, how much money do you want to give to an heir or to your family members so that they can be financially more stable after your departure? That's a key call out, is you want to make sure the financial calculations are done to determine what do people need upon your passing? What kind of lifestyle do you want to lead them to have, or have them enjoy after your passing? So again, that also changes over your life as you continue to age. But that DNA test is really important. So I urge you all to go through the exercise with one of the advisors.
What are your life insurance options? All life insurance products fall under two broad types. You've got term insurance and you've got permanent insurance. Term insurance is really simple. It allows a policyholder to purchase a coverage for a specified period of time at a specified price. Term insurance is normally less expensive than permanent insurance. Permanent insurance does not expire. It remains in place as long as the premiums are being paid. When individuals purchase term life insurance, they pay a specific premium to buy the life insurance coverage for a specific period of time. If the policyholder dies during that time, his or her beneficiaries receive a benefit from the policy. If he or she outlives the term of the policy, it is no longer in effect. The person would need to reapply to reinstate the coverage. They're going to be older, and they have to also qualify for health reasons. Unlike permanent insurance, term insurance only pays a death benefit. That's one of the reasons term insurance tends to be less expensive than permanent insurance. There are four broad types of permanent life insurance. The first, which everybody's probably heard of, is whole life insurance. Whole life insurance is a life insurance that remains in force for the policyholder's entire life, as long as he or she stays current with their premiums. In exchange for these fixed premiums, the insurance company promises to pay a set benefit when the policyholder dies. Unlike term insurance, policies build up cash value, effectively a cash reserve. It's a modest rate of return. The growth on this cash value will grow tax deferred. No 1099 like with your CDs or anything like that. With whole life insurance, the withdrawals of the earnings are fully taxable at an ordinary income tax. If you are under the age of 59 and a half when you make a withdrawal, you may be subject to surrender charges or assessed a 10% federal income tax penalty. Also, any withdrawals will reduce the benefits and value of the contract. Variable life insurance. A variable life policy is a form of a universal life insurance. It's a permanent insurance that provides a flexible premium and an adjustable benefit, meaning the policyholder decides how much to contribute above the minimum premium, potentially increasing the face value of the policy. But there's an important difference. With a variable universal life insurance policy, the policyholder directs how the premiums are invested by allocating them to one or more investment subaccounts. Depending on the policy, these subaccounts could include a fixed interest rate option, as well as various stock, bond, or money market choices. This provides access to potentially higher returns provided by the financial markets. It also means returns could underperform those provided by other life insurance products. Variable life insurance combines the protection and tax efficiency of life insurance with the investment potential of a comprehensive selection of variable investment options. The insurance component provides the death benefit coverage, and the variable component gives the flexibility to potentially increase the policy's cash value. Variable insurance products are subject to investment risk and not guaranteed and will fluctuate in value. In addition, there's no guarantee that any investment option will meet its stated objective. When considering a variable life insurance, investors should consider the investment options, objectives, risk, charges, and expenses of the variable insurance contract and the subaccounts carefully. The prospectus contains this and other information about the variable insurance contract and its subaccounts. You can obtain contract and underlying subaccount prospectuses from the financial representative. Please read the prospectus carefully before you invest and assess your needs for the death benefit coverage. Also, please remember that money held in a money market fund is not insured or guaranteed by the Federal Deposit Insurance Corporation or any other government agency. Money market funds seek to preserve the value of your investment at $1 a share. However, it is possible to lose money invested in a money market fund. This raises a couple questions. Should you choose fixed or variable? A fixed policy offers a guaranteed fixed rate of return. It's dependable, though more conservative. A variable policy offers some degree of investment flexibility. The policyholder allocates his or her premiums to different investment subaccounts. This gives the policyholder access to potentially higher returns provided by the financial markets. It also means there is a risk of a lower return. Whether you choose a fixed or variable policy depends on your individual situation. You'll need to take into account your complete finances, including your cash reserves, your investment portfolio, and any business interests. Any guarantees associated with a policy are dependent on the ability of the issuing insurance company to continue making claim payments. Permanent life insurance policies also offer an additional benefit, access to the cash value. Under certain conditions, policyholders can usually borrow a portion of their policy's cash value under fairly favorable terms. And interest payments on that policy loan go directly back into your policy's cash value. Loans taken from a policy will be free of current income taxes provided certain conditions are met, such as the policy does not lapse or mature. Keep in mind that loans and withdrawals reduce the policy's cash value and death benefit. Loans also may increase the possibility that the policy may lapse. If a policy lapses, matures, or is surrendered, the loan balance would be considered a distribution and would be taxable to you. Withdrawals of earnings are fully taxable at ordinary income tax rates. If you're under the age of 59 and a half, when you make a withdrawal, you may be subject to surrender charges and assessed a 10% federal income tax penalty. Life insurance is not FDIC insured. It is not insured by any federal agency, bank, or savings association. And from there, we're transitioning to long-term care.
Yes. All right. Thank you, Tori. All right. Let's get into long-term care. Now, long-term care, uh, you know, assessing and addressing the potential threat of these expenses is one of the greatest and largest financial challenges an individual can have when they really sit down and develop their retirement strategy. The U.S. Department of Health and Human Services actually estimates 70% of the people over the age of 65 can expect a need for long-term care services at some point in their life. Now, think about that. That's 7 out of 10. 7 out of 10 people age 65 or older are going to have a need for long-term care. That's a number, and that's a substantial number that needs to be looked at and addressed. So understanding these types of long-term care services and how those services cost, and it's critical to understand and actually start planning for. So what exactly is long-term care? Let me talk about that. Long-term care is not a single activity. It actually refers to a variety of medical and non-medical services needed by those who have a chronic illness or disability, most commonly associated with aging. Long-term care can include anything and everything from assistance with activities of daily living. Those are called ADLs. Maybe you've heard that before. So if you heard the term ADLs, that means activities of daily living. Now, what are those? That means like you might need help dressing yourself, you might need help bathing, using the bathroom, transfers, etc., like driving, even driving to the store. For more extensive therapy and medical care even being required by services of a skilled medical personnel. Those are all key call-outs when you look at ADLs. Now, long-term care may be provided actually in your own home. It could be in a community center. It could be in an assisted living facility or community. And it also could be in a skilled care nursing home. Now, long-term care is not exclusively for the elderly. It is usually for the elderly, but not always. It is possible to need long-term care at any age. I can tell you that. Now, how much does it cost to have long-term care? Well, long-term care costs vary literally state by state, even region by region. There are a variety of strategies that we're going to touch on here and are available. And we're going to cover 8 strategies for this long-term care. But most important note I want to make as we get into this long-term care area is the information I'm going to present today is purely for educational purposes only. I am not making any recommendations without fully understanding an individual's unique needs and their own situation. So let's get into these strategies. The first one, many people think about Medicare. Well, Medicare is not one of the options that you really should be thinking about. Even though I've listed it as an option, I want to make sure you understand it is not. Most people believe long-term care needs will be covered by Medicare, and Medicare actually is designed to pay for short stays in skilled nursing facilities that provide rehab and therapy services after a hospital stay. So you've gone to the hospital, they're now going to discharge you. They send you to a nursing facility for rehab or for therapy. Yes, then that skilled care services are covered, but not for long. Medicare does not cover long-term extended care. Now, in contrast, though, there's something called Medicaid. Medicaid actually covers long-term care costs at home and in a skilled nursing facility. In fact, Medicaid is the primary payer for long-term care services. The biggest issue is that many people who need long-term care actually never qualify for Medicaid assistance. Here are the top disqualifying reasons, and there's 4 of them that disqualify most people for Medicaid, okay? The first one is the income threshold. Income thresholds actually have very small limitations here. You must have a limited income as well as very, very low level of assets in order to qualify. If one is above any of those thresholds, whether it's income or assets, you need to spend down those assets in order to utilize Medicaid. Now, here in Arizona, I pulled the numbers for 2024. The Medicaid gross income limits for an individual is $2,829. That's $2,829 a month. And the asset limit is $2,000. I mean, that's a low, low number. Now, if you're married, applicants must have a monthly combined income of $5,658. And each spouse is having up to $2,829. So it's really, as I say, a number that is low. And then on top of that, you have that concern. So make sure you recognize the income threshold. The next call out I want to make is this look back clause. Now, some people think, oh, I know what I'll do. I'll just give all this money to my kids or some family members or whatever so I can then qualify. Well, be careful. There's usually a look back period when assessing for eligibility. And in most cases, a review of financial records going back 5 years is done. So they'll check for 5 years to see and to uncover whether or not any assets were sold or given away to meet the state's asset limits. So be aware of that. Now, Medicaid, also you might come into this Medicaid pending status, and that can be for a period of time, and you're kind of in the limbo zone here. Even if an individual qualifies, there might be a period where we say this Medicaid pending, where benefits have actually been denied or the recipient is not fully approved. And this can be very stressful, especially if immediate care is needed. Not all facilities will accept somebody or a person who is in this pending status. Now, bed availability is also an issue. There may not even be a bed available in your preferred facility. See, not all facilities make beds available in this Medicaid area. And if you need a bed and you need to have this care, you might have to go to another town or city nearby in order to get the availability for the bed. So that's a key call out too. So be aware. Now, let's talk about the second way people fund their long-term care. They call it self-funded. Perhaps an individual cannot qualify for long-term care insurance due to an existing health insurance or a health issue, for example. So in this situation, they actually have to use their own savings or their own investments to pay for their care out of pocket, and they have to set money aside for this and thinking about it for a 2 or at least a 3-year period for long-term care costs. Now, planning early is key because that gives you the best chances to save more money. I urge you to stay and live under your needs so that you can save more money and compile it so that you'll have a pool for this self-funded option. Now, the downside to this approach is not knowing how many years of care might be needed. Now, I'll mention this. Alzheimer's, for example. Alzheimer's has an average life expectancy after it's been diagnosed of about 8 to 10 years. Wow. I mean, according to the Alzheimer's Research and Prevention Foundation, it's 8 to 10 years. So the funds to cover a few years in a facility might be available, right? You might be able to have that, But for an extended stay, well, that'll actually use up your assets and you'll have nothing left for your beneficiaries, perhaps. Another version of this self-funded approach, I like to call it the do nothing plan, or to ignore the realities of the real risks of needing long-term care. Also, it's worth noting that some might even need to turn to family members or others for financial assistance in this time of need. So, for example, I want you to know the average cost of long-term care right here in Arizona. In 2024, it can actually range from $56,000 all the way up to $100,000 a year. Actually, depending upon the level of care you need and if you have a private room or a shared room. Home health care's costs actually can range also on the more low side. So home health care is a very good option and a strategy. Another interesting fact is the average for women that need long-term care actually is 3.7 years. So almost, closer to 4 years. Whereas men, the average long-term care need is about 2.2 years, a little bit shorter. But again, those are all factors you need to be weighing that in. So if you're looking at, say, 4 years at, say, $50,000 or $60,000 a year on the low side, you're looking at well over $200,000, $240,000, $250,000, or even more. So it's critically important to understand how that self-funding can work. The option 3 is another strategy using your pre-tax savings IRA to purchase long-term care protection. Retirement assets can be surprisingly substantial and a good source for long-term care needs. The Secure Act 2.0 actually reduces the IRS penalty for taking out less than your full retirement, your RMD rather. Also, your requirement for taking the RMDs was raised from age 72 to 73 for any person who attained 72 after December 31st of 2022. And actually, it's been extended out for younger folks to even go out to age 75. But it's important to contact and to work with your investment professional and your tax advisor about your specific situation, whether or not you want to use your pre-tax savings in your IRA. Now, death benefits, when you use those benefits to buy, for example, in this illustration, you would buy a hybrid life insurance policy that actually has a combination of long-term care benefit as well as death benefit. That can actually be a very attractive strategy too. But this involves a little bit of tax planning, and make sure you work with your advisors in evaluating that carefully. The fourth option is Roth IRAs. Now, remember, assets that you pool from the traditional IRAs are taxed as ordinary income. But luckily, IRAs under the Roth IRAs are funded with after-tax money and have the tax-free growth, the tax-free withdrawals, and no RMDs. Earmarking a Roth for long-term care costs or the premiums for long-term care insurance may be an excellent strategy. Funds can be used to pay for long-term care costs or pay for the premiums for those coverages. Higher earners, this is another thing I'll call out. High earners will also benefit by using what is called a backdoor Roth IRA. This is an IRA or an IRS permitted method allowing one to fund their Roth IRA even if income is higher than the IRS limits for the standard Roth contributions or conversions. Now, please note though, taxes must be paid on monies converted to a backdoor Roth IRA, and it will be likely counted as income and possibly even push you into a higher tax bracket. But again, always speak to a tax professional to help assess your own unique tax situation. But Roths are a wonderful technique and a wonderful vehicle to use when paying for long-term care costs or insurance premiums. Number 5 is even, I think, a better one, and that's the health savings account, the HSA accounts. If any of you have an HSA account, it's a hidden jewel in your long-term care and retirement planning arsenal, as I say. The approach is simple, it's effective, and very tax advantaged. Contributions that you made to your HSA actually reduced your annual taxable income, and it grew tax deferred until your monies were used to cover those eligible health care expenses. Now, HSA withdrawals, when you pull them out for medical expenses or even long-term care insurance premiums, can be tax-free when they meet certain requirements or guidelines. Now, based upon your age, you can use those HSA monies tax-free to pay those long-term care insurance premiums. If you take a look at the chart, you can see. Now, to make this work, long-term care policy must also cover long-term care, must only cover the long-term care services. So this is an important thing to look at, and most long-term care insurance policies can qualify. Now, after you're 65, this is a call out. People say, wait a minute, I have a lot in there and I might not use it all. Well, guess what? After 65, the money can be used that you have in an HSA for absolutely anything without any penalty. Now, although there's going to be ordinary income taxes will be due on some of those withdrawals. While there are annual contribution limits, when you put money in, there are limitations on dollar amounts, but there's no maximum accumulation limit within the HSA. So it can grow and grow and grow and become quite sizable. For example, the 2024 HSA annual contribution limits, what they're coming in at about $4,150 for an individual, but actually $8,300 for a family contribution limit. And if you're over 55 and a half, you can actually add a $1,000 catch-up provision too. So HSAs are a wonderful vehicle when it comes to long-term care payments and strategy. Now, number 6 strategy is, geez, how do we use the equity in our homes? Well, there's one technique called a reversed mortgage. All right. Now, individuals wishing to cover long-term care costs actually can leverage perhaps their greatest asset, as I say, that's their home. And they can do it through a reverse mortgage. Now, let me explain how it works. There's lots of technicalities when you get into this, but it's a very effective strategy for some people to consider. Now, for those that are 62 and older, what will happen is the lender actually makes a loan in a lump sum or maybe a monthly installments or as a line of credit even for the homeowner. The loan is typically paid back with interest when the home is actually sold. So for seniors, there is some comfort in knowing that the home equity conversion mortgage is actually insured by the U.S. federal government. So here are a couple key call-outs that I want you to know. One is homeowners can never be forced out of their home. Number 2, loans are not counted as income and does not affect Medicare or Social Security benefits. It may, however, affect your Medicaid eligibility if you're trying to spend down your assets. Now, there's no restriction on how the money can be used. Loans can fund your home health care. For example, having that care done at home. It could pay for adult daycare. It could be used for premiums, for long-term care coverage, etc. No one can, one can even use the proceeds to make their home safer. I've seen people use it to install maybe ramps or handrails in the home to make it easier and safer so that you can actually live in your home a little longer. Now, if someone passes, the remaining spouse can actually still live in the home safely and securely. Now, this option may not be the best solution if both spouses need care and enter a facility, because the reverse mortgage becomes due when the last borrower dies or moves out of that house. So when the home is sold to repay the mortgage, if the proceeds of the sale are less than the mortgage, the lender must take the loss and cannot go after any assets of the homeowner or the homeowner's estate. So in some cases, however, the homeowner cannot pass the property to any heirs. So recognize, once you do this, this is pretty much going out, and the heirs may not receive any benefit from that home. But they could, but they may not. There are some important considerations when using a reverse mortgage for long-term care. I want these to be known, and that's like the lender may want or will want to make sure the homeowner is financially capable of maintaining the home. And in some circumstances, the lender may even require some money be set aside to cover certain costs for the home maintenance in the future. Now, the borrower can live outside the home. For example, think about a nursing home for up to 12 months before the loan is actually due. This could be an issue for one spouse. If we have one spouse, say, in a nursing home and the other dies while still living in the house, the loan then becomes due within a year. So we've got to be careful of that issue. And then finally, the negative about a reverse mortgage can actually be the costs. The closing costs for a reverse mortgage can be quite high, seem to be up to 8% of the loan amount, significantly higher than a home equity line of credit. Now, in some things, as I say, these are all things to consider and digest as you look at these as an option. Number 7 is actually a home equity line of credit. It's not a reverse mortgage. This is just actually a straight out home equity line of credit, or what they call a HELOC in the banking industry. It can be a great alternative to a reverse mortgage and actually be a very quick and easy way to access money for care and or insurance. The loan is actually based on the equity of the person's home, and actually will be cheaper than the reverse mortgage, which tend to have those, as I said, those higher closing costs. Now, borrowers might be able to access up to about 80% of the home's values. And additionally, HELOCs are extremely flexible as it relates to withdrawals and payback periods. To top it off, interest, this is a nice call out too, the interest on those HELOC loans can be and may be tax deductible for you in the year the interest is actually paid. Now, furthermore, there is no requirement for the homeowner to maintain residence while the loan is in place. In this scenario, a HELOC has a clear advantage over a reversed mortgage. And what if a person needs to sell their home and move into a facility? Well, the HELOC can provide an excellent bridge strategy covering costs and expenses until the home is actually sold. Now, let me tell you, HELOC does have some downsides, and a couple of the downsides are, if the homeowner is unable to repay the loan, well, the lender could foreclose on the property. Another one is, now it's rare, but sometimes a lender may or could freeze your HELOC, freeze the loan without ample warning. So you just have to be aware of that and know those considerations. All right, the last strategy I'll mention here is the 8th strategy. And this is when you're using an existing insurance policy to help fund long-term care. Now, you may have some older life insurance policies that have built up cash values, and actually that can be a great option to consider for using and actually converting, for example. But what I'll call out here is that you could sell the policy. You know, you could actually sell an older traditional policy. Maybe you don't need much anymore. You could sell it to a life settlement company. And those proceeds will depend upon the age and the health status of the policyholder. Also, some life insurance policies offer something called an accelerated benefits. And they're in the form of a cash advance, basically, of the death benefit. And some insurance carriers may make this accelerated benefit available even if it's not in the contract. This is something you just need to talk to your insurance company about and see if they're willing and they're able to offer that as an option. Either way, the upside may outweigh any reduction in the death benefit for the beneficiaries. So good thing to look at. Really good thing to look at. Wow, we've talked about a lot of things here and trying to sum it up. And I'm trying to keep our time under constraints here because we get lots of good questions. But let me sum it up here. First, life insurance, as Tori went over here, offers protection in case you die when for those that depend on you while they still need you. It also offers other estate and tax benefits for you to consider. Thinking about long-term care can be difficult, I know, but you know what? It's necessary. It's an important conversation to have with your spouse, your family members, even your advisors. So here's my call out. I urge you to start small. Start small with an initial conversation to get the ball rolling. Actually, it can help and go a long way in solving this. Next, have a deeper discussion with your financial advisors and understand the risks and the costs of long-term care are actually among the highest of all the expenses someone could have during their retirement years. I've seen wealth literally wiped out because of not proper planning. Fortunately, there are various solid tactics and solutions that are available. And given this enormous impact, I need to call that out to you. There's a real benefit in having these conversations sooner versus later. So please reach out to your wealth advisor or your CPA, your tax professional to begin conversations now. So here's my call out. Let's make it a quote, before end of the year resolution, end quote. Again, let's make it to that before the end of the year resolution to begin dialogue, to begin conversations and strategy thinking for your long-term care. So let's go to some questions. Wow, we've got a number of questions that have already started to come in. We've come and we have them lined up, and Tori and I are going to address them. So let's get started. Tori, here's the first one, long-term care. Anything that precludes you from receiving this, for example, a bad knee, etc.?
Traditional policies, yes. You have to
Yeah.
go through underwriting, much like a life insurance contract.
Mm-hmm.
Life insurance and long-term care tend to be, well, especially long-term care, tend to be one of those things people want when they think they can't qualify for it. So obviously, if they have dementia or Alzheimer's, that's a no-no. Stroke, cancer,
Mm-hmm.
diabetes, all those things will be factored in.
Mm-hmm.
But yes, but there are other policies that aren't your traditional type you might qualify for. So you just got to sit down with an advisor and we'll go through that process.
Yeah, things have changed, haven't they?
Absolutely.
All right, here's another question. In your opinion, would a universal life with a long-term care rider of $350,000 be enough? That's a great question. First of all, congratulations, whoever wrote that. I assume you own this and you've taken good steps already to address the realities. Well, the question is, will $350,000 be enough? That's a good question. I don't know. Depending upon the level of care you want and where you want that service to be provided. If you want to be in a very luxurious retirement community, it might be low. You might need more. However, if you're willing to go for something standard or more moderate, it may be just enough. The other call out is how long you'll need the care, right? We just talked about Alzheimer's. Might be 7, 8, 10 years maybe that you might need services and care. And will or not that 350,000 be enough for an Alzheimer's care? I'm not certain that it will. But at least you've taken good steps. I congratulate you on it. And yes, take a look and evaluate that and understand there's various levels of need out there, and you want to make sure you're addressing it. Now, I'll just, before I go on to that next question, let me say this. I know this is another technique that some people will use is, I don't need to buy enough insurance for all of it, maybe for half of it, for example. Well, in that case, 350,000 is definitely going to be ample enough, I think, for at least half of it, maybe more, clearly. So it's important to recognize maybe the coverage you buy, you're not looking at taking all of the using all of it to cover it, maybe just half of it or a portion of it. And that's smart. That can be very smart also. So you self-fund some of it and you insure some of it also on the other side. All right, here's another question. Do you know people who have long-term care insurance? It says, I know people. That's what they're saying. I know people who have long-term care insurance and premiums, but they seem to go up every year. Is that still the case? Tori, you want to answer that one?
Absolutely. Yeah, insurance companies tend to put it's typically what I've seen 10 years where they can kind of re-underwrite a policy. And if their costs have gone up substantially, they can raise your monthly premium. So that has scared away some consumers, and the insurance company is great at reinventing the wheel. So, part of what we do isn't just those traditional policies where you pay monthly. You can also look at what's called an asset-based long-term care. Just like that life insurance policy, from the insurance company's standpoint, they're going to pay out 350,000, whether you pass away or whether it's to an assisted living facility. Another one that's easier to qualify will be on an annuity chassis, another insurance product where you can put in 50,000 and you might immediately have $150,000 of long-term care insurance.
That's become a very popular, and it's a newer version. So much like the older traditional long-term care policies, quite a few things have changed over the years. So again, I urge you to do a review and see, do you have the right coverage and the right policies for what you have and your needs. All right, here. How may a 35-year-old person benefit for life insurance, and is there any downside? Well, I'll take that one, Tori. 35-year-old person, do they need life insurance? Well, yes, they probably do. Again, it depends upon, do they have financial liabilities that will be left behind if they pass away? Who's going to be obligated to pay those? And then the second part is, will there be other financial burdens that might be left behind, or income shortfall, for example, that you want to now backfill? So what life insurance actually can do is create an estate. It can create dollars, all tax-free, mind you, and that can be a wonderful blessing. So the key call out is, do you have the right amount of insurance for what your family needs are? If you're 35 and single, maybe you won't need much at all. But if you're 35 and married and have several children, you may have a huge amount of insurance needs in case something would happen to you and you happen to be the sole breadwinner. Now, a call out too is sometimes you have to think about the spouse. If it's a working spouse, they do have financial contributions to the family. And if it's a non-working spouse, they have also financial needs that need to be cared for, or where you're going to require them to go to work, right? So these are all considerations you have to evaluate and think about, and do it in the right way. You might start off with term insurance, get it going so you have the highest amount of coverage you can at the lowest cost, and then gradually over time look to convert that or change that to something more permanent or more long-term. All right, I was told I cannot purchase long-term care insurance because I am on Social Security disability. Is that true, Tori? What do
I
you
guess
think?
it's going to depend what you're on disability for, but that certainly will be a factor.
Mhm.
Long-term care insurance is going to go through an underwriting process, much like life insurance. But like Tom alluded to earlier, there's a lot of options. Even if somebody's in a nursing home and they've got dementia or Alzheimer's, there is accelerated annuity options out there that can pay as much as 15 to 20% for that
Mhm.
individual's life. Now, if something happens to them a day after buying that policy, whatever they use to fund it, that money's the insurance company's. But there is
Mhm.
options out there for just about everybody. They may not be the best, but you can always take a look.
Yep, yep. Here's another one, Tori. How do you start saving for retirement starting so late?
Um, I guess
We
it
hear
depends.
that.
Well, you just got to start. You got to put one foot in front of the other. If you're still
Mhm.
working, your company has a
Mhm.
3% match on their 401k, a 5% match. You got to take advantage of that match. You got to sit down with a financial planner, much like we have here at OneAZ, where we can create that roadmap going from point A to point B. Maybe we have to work a little bit longer. Maybe we do part-time work at retirement where we're working 3, 4 days a week. And maybe we got to take on some risk we're not really comfortable with. But there's ways of doing it.
Yep, that's right. It's never too late. The most important thing is to take the steps. You're sure for sure on that. Is there long-term care in your home, Tori? Can you get
Yeah,
long-term
certain
care in your
companies will
home?
do that. You
Mhm.
see it a lot with life insurance chassis where, like that we spoke about earlier, where we bought $350,000 life insurance. They might have some requirements, especially if you want it to be a family member. They might have to do some kind of certification or training, but it really depends on the carrier. Some do and some don't, to answer the question.
Yeah, and that's a call out. I remember back 15 years ago, the policies that were sold, many of them didn't have home health care options. And now in today's world, some policies do, which is a real big advantage for sure. Okay, options for life insurance past 55 that don't cost an exuberant amount for very little coverage. Yes. Well, there are options. There's a variety of life insurance options for anybody at any age. As a matter of fact, the next question says, can I buy whole life insurance at age 73? You certainly can. I think the oldest person I've ever sold whole life insurance to was in their mid 80s. It was a very unique situation. It was an estate planning case. We had to involve quite a bit of medical underwriting and different insurance companies, but actually it was the tax purposes and the tax reasons and the estate plan was well worth it and provided huge benefit to the family members. So yes, there's a variety of reasons, and yes, you can buy whole life insurance. Depending upon, again, how healthy you are. So the healthier you are, make sure you get it when you can. How does the individual begin to know what life insurance is right for them? Well, Tori, I think you kind of covered a lot of that earlier on.
Yeah, it's going to depend on their financial situation and what their goals are. If they just want the
Mhm.
coverage for a specified period of time, then it's term all day long. If they want to
Yep.
try to make the cash value grow tax deferred, maybe get some tax free income down the road. Well, that's a more complex conversation.
All right, listen, we're running out of time. I want to wrap it up. I have a wrap up slide here. I want to say thank you. Thank you for sharing all again the information we kind of brought up had a lot of interesting things about life insurance and long-term care coverages. Um, and where do you go? Where do you turn? I want you to know OneAZ Wealth Management is located within all of the OneAZ Credit Union branch network. We urge you to come in and visit us, and we specialize in helping people just like you, assessing your needs, evaluating options, what's best for you, and how will those needs be best met. So, to wrap it up, I want to say thank you. Thank you, Tori, for your presentation and insight. And for those watching and listening, thank you for joining. We hope this discussion today has helped you see new insights, new ideas on long-term care, as well as life insurance. All of us here at OneAZ Wealth Management welcome your feedback and your comments. So I urge you to, again, please email us with your suggestions that you have for any future topics. And as always, our entire team of wealth advisors stand ready, willing, and able to review your current financial plan and your portfolio in light of today's economy. There's no better time than right now and the present for a second opinion for your current plan. Many of our clients actually have had advisors at other places before they've come to us, and they've come to learn things, discover new ideas, even new strategies that are better suited to their needs. So again, we welcome your call. Please call us at our toll-free number at 877-566-0517, or you can visit us at our oneazwealth.com website for more information in creating your personal financial and retirement plan. And lastly, again, thank you for joining us. From all of us here at OneAZ Wealth, we want to wish you the very best for the remainder of 2024. We want to wish you safety, your health, as well as your wealth. Take care and goodbye.